Every war comes with a price, but that price is never sent to the people who ordered it. If you think the cost of modern war shows up on your tax bill, you haven't looked closely enough. There are no emergency surcharges, no sacrifice stamped across your paycheck, no bond drives on the corner of every street. The wealthy neighborhoods that cheer the loudest, they don't feel it first. Markets often rise when conflict begins. Defense stocks climb. Politicians step to the podium and tell you the nation can handle this. The message is always the same. We can afford it. But here's what they don't say. Wars are almost never paid for when they're fought. They're financed, and financing changes everything. Welcome to Margin Call Stories, where money, power, and history collide. And nothing is ever as clean as it looks. There was a time when war hurt immediately. In medieval Europe, a king who wanted to go to war had limited options: raise taxes, seize land, debase the coinage, mix the silver with cheaper metals and hope no one notices. Whatever path he chose, the cost was visible. Brutal, immediate. The peasants felt it first. They always did. Consider the 100 Years' War, England versus France, dragging on from 1337 to 1453. Financing it meant squeezing already exhausted populations. Monarchs taxed merchants, clergy, landowners, anyone with something left to take. The fiscal pressure tore regions apart. Revolts weren't rare. They were expected. War was expensive. And everyone knew exactly who was paying. Spain learned the same lesson under Charles V and Philip II. Endless campaigns across Europe and the Americas drained the royal treasury dry. The Spanish crown declared sovereign default in 1557, then again in 1575, then again in 1596. Even the vast silver shipments from the New World couldn't keep pace with military ambition. Back then, the constraint was simple. If you wanted war, you had to take money from someone, immediately. And immediate extraction creates resistance. But in the late 17th century, something changed. Something that would permanently alter the relationship between war and money. In 1694, the Bank of England was founded. This wasn't just another financial institution. It was a structural revolution. For the first time, a government could borrow, at scale, from private lenders, backed by the authority to tax in the future. This was the birth of modern public debt. Instead of raising funds up front, Britain could issue bonds, long-term promises to repay, with interest. Investors bought them. Wars against France, the War of Spanish Succession, the Napoleonic campaigns, were financed not through immediate confiscation, but through borrowing against the future. By the end of the Napoleonic Wars in 1815, Britain's debt-to-GDP ratio had climbed above 200%. A number that would send modern headlines into a spiral. But the real innovation wasn't the size of the debt. It was the concept. War had become financeable. Governments no longer needed to break their populations immediately. They could spread the cost across decades. Consols, perpetual bonds, allowed Britain to pay interest indefinitely without ever repaying the principal. The burden was transformed from a visible tax into a quiet, long-term obligation. Once governments discovered that wars could be funded through debt, there was no going back. Fast forward to the American Civil War. The Union faced enormous expenditures. It issued war bonds. It also printed greenbacks, paper currency backed by nothing but promises. Inflation followed. Prices climbed sharply. The cost didn't come through taxation alone. It arrived through the slow erosion of purchasing power. World War I scaled this model dramatically. Governments across Europe issued massive quantities of bonds. Citizens were encouraged, sometimes pressured, to buy Liberty bonds in the United States, and similar instruments everywhere else. Posters called it patriotic duty. It worked, but bond issuance alone wasn't enough. Governments suspended the gold standard, expanded the money supply. Inflation surged across Europe, and in Germany, the consequences went beyond inflation, into something catastrophic. By 1923, Hyperinflation had wiped out the savings of the middle class. The mark collapsed. Life savings evaporated overnight. The social fabric tore. Inflation is often described as an unfortunate side effect of war. That framing is too gentle. Inflation is a mechanism. It is one of the primary ways wars get paid for. When governments can't raise enough in taxes and can't borrow cheaply enough, they expand the money supply. They print. That printing reduces the purchasing power of every dollar, every mark, every franc already in circulation. Everyone holding cash or fixed income assets pays through dilution. No invoice arrives. But the extraction is real. World War II followed a similar path, with more sophistication. The United States issued enormous quantities of war bonds. Federal debt rose from roughly 40% of GDP in 1941 to over 120% by 1946. That is a wartime explosion of leverage. After the war, Washington didn't slash that debt through aggressive taxation. Instead, it turned to a quieter strategy: financial repression. Interest rates were held artificially low while inflation ran higher. If inflation is running at 4% and your government bond yields 2%, you are losing purchasing power every single year. The government repays its debt in cheaper dollars. Nobody calls it theft, but the arithmetic is what it is. Financial repression allows governments to erode debt burdens gradually. It transfers wealth from savers to borrowers, and governments are the largest borrowers of all. Now notice the pattern. Debt spreads the cost forward, into the future. Inflation spreads the cost downward, across society. Financial repression smooths it quietly over decades. Meanwhile, those who own hard assets, land, commodities, equities, companies tied to wartime production, often experience a very different story. During inflationary periods, real assets tend to rise in nominal terms. Defense contractors receive contracts, industrial firms ramp up production, capital owners can adjust prices, wage earners cannot adjust as quickly. If you were holding cash in Weimar Germany in 1923, you were ruined. If you held foreign assets or real property, you survived. If you were a middle-class saver during the inflation of the 1970s in the United States, partly driven by Vietnam War spending and oil shocks, your purchasing power eroded sharply. But if you owned oil-producing assets or commodities, the story looked completely different. War financing does not hit evenly. It cannot. The mechanism itself prevents equality. And here's the part that rarely gets said clearly. Modern wars feel cheaper because the cost is abstracted. No emergency war tax on your paycheck. Instead, deficits widen. Central bank balance sheets expand. Treasury auctions grow larger and larger. The United States entered the wars in Afghanistan and Iraq after 2001 without raising broad-based taxes to fund them. Federal debt doubled between 2001 and 2008. The bill was deferred. Borrowing filled the gap. Nothing communicates long-term fiscal discipline quite like funding 2 decades of war on a credit card. But the credit card still has a statement date. Debt accumulation is not neutral. It must eventually be serviced. And servicing debt constrains future policy. It pressures central banks. It narrows fiscal flexibility. It increases dependence on low interest rates and monetary accommodation. When borrowing grows large enough, inflation stops being a side effect. It becomes a release valve. You saw this dynamic again in the early 2020s. Massive fiscal stimulus, emergency spending, supply disruptions, geopolitical tensions. The money supply expanded dramatically. Inflation surged from 2021 through 2023 across much of the Western world. The official explanations focused on supply chains and pandemic distortions. Those factors mattered, but beneath them was something deeper. When governments spend aggressively and finance it through debt monetized by central banks, purchasing power shifts. And purchasing power always shifts away from those who hold currency. This is the structural reality most people never stop to examine. Because the sacrifice isn't visible. There are no ration lines, no conscription notices arriving at every door. The cost is diffused across years, across balance sheets, across generations. The soldiers go to the front. The bill goes to the future. When a government decides to go to war, it doesn't walk into wealthy neighborhoods and hand out invoices. It doesn't knock on the doors of multinational asset managers and demand proportional sacrifice. Instead, it activates a system that looks neutral on the surface: bond markets, central banks, budget committees, but produces deeply uneven outcomes. Let's follow the money. When war spending ramps up, governments issue bonds. Those bonds are purchased primarily by institutions, banks, pension funds, insurance companies, foreign governments. On paper, it looks like a voluntary exchange. The government gets cash. The bondholder gets a promise of repayment with interest. But in large-scale conflicts, central banks typically step in. They purchase government bonds. They expand their balance sheets. They flood the financial system with liquidity. This keeps interest rates low and ensures the government can keep borrowing without triggering market panic. In simple terms, the state spends, the treasury borrows, the central bank stabilizes, the financial system absorbs. The immediate shock is muted. No dramatic tax increase for the median household. No visible austerity at the outset. It all looks manageable. But manageable does not mean free. The cost appears later, through higher debt servicing burdens, and through inflationary pressure that erodes real wages. And that erosion does not reach everyone equally. Consider defense contractors. During World War II, American industrial giants, General Motors, Boeing, Lockheed, transitioned into wartime production and watched enormous government contracts flow in. Production boomed. Corporate profits surged in key sectors. War mobilization solidified industrial dominance. Fast forward to the 21st century. The post-9/11 wars in Afghanistan and Iraq generated trillions in expenditures. Halliburton, Lockheed Martin, Raytheon. Firms embedded in the defense ecosystem received massive contracts. Share prices reflected that demand. Investors holding those equities didn't experience war as a drain. They experienced it as revenue. This isn't about villainizing companies. It's about understanding structure. When a government concentrates spending in one sector, capital flows there. Asset owners in that sector benefit. Now contrast that with the average wage earner. During wartime inflation, wages tend to lag price increases. Housing costs rise. Energy costs rise. Food prices climb. If you're earning a fixed salary and your expenses inflate by 6 or 8% while your wage grows by 2 or 3, you absorb the difference. Every month, quietly. Inflation is a tax without legislation, and like most taxes, it is regressive when measured against financial sophistication. If you own real assets, property, equities, commodities, you have some protection. If you hold cash savings in a bank account earning near zero interest while inflation runs above it, you lose purchasing power. Silently. Every single day. After World War II, many Western governments reduced their enormous debt burdens, not by dramatically taxing the wealthy, but by allowing inflation to run above interest rates for extended periods. Financial repression steadily reduced the real value of outstanding debt. Savers lost, debtors benefited, and governments, the largest debtors of all, benefited most. Here's the deeper pattern. War accelerates wealth concentration when financed through debt and inflation. During World War I, European aristocracies suffered, but industrial capitalists tied to war production often expanded their influence. During World War II, the United States emerged with its industrial base completely intact while Europe lay in ruins. American corporations gained scale. They gained global reach. In more recent decades, prolonged military engagements combined with accommodative monetary policy have coincided with rising asset prices. When central banks hold interest rates low to support government borrowing, cheap money flows into equities, real estate, and financial markets. Asset owners see gains. Meanwhile, those dependent solely on wages face rising living costs. The wealthy rarely foot the bill. Because the mechanism of payment is structured around assets and liabilities, not morality. Those with diversified portfolios and exposure to appreciating assets are insulated from monetary erosion. Those living paycheck to paycheck are not. And here's the psychological trap. Because the cost is diffused, there is no single moment of reckoning. No day when citizens line up to pay a war surcharge. Instead, there are years of slightly higher prices, slightly higher debt ceilings, slightly larger central bank balance sheets. The sacrifice is incremental. And incremental means invisible. Modern Western societies haven't felt war in their pockets the way earlier generations did, because the burden is financialized, distributed across time, obscured by accounting. But obscured does not mean eliminated. Take the United States today. Federal debt now exceeds 120% of GDP. Annual interest payments have become one of the largest line items in the federal budget. That interest must be paid before anything else is funded. And when interest rates rise sharply, as they did in 2022 and 2023 to combat inflation, the cost of servicing accumulated debt increases dramatically. Governments face a painful dilemma. Allow inflation to persist and erode purchasing power, or raise rates and stress the financial system. The uncomfortable reality is this. Wars are financed by leveraging the future. They are paid by currency holders, by savers, by those without asset protection. They are absorbed by generations that had no vote in the original decision. You may not have seen a war tax on your paycheck, but you have likely seen higher grocery bills, higher rent, higher energy prices. You've likely watched government deficits expand into the trillions. You've likely seen central bank balance sheets balloon to levels that would have been unimaginable a generation ago. These are not abstract numbers. They are the accounting entries of geopolitical ambition. Understanding this is not cynicism, it's financial education. When you grasp how wars are actually funded, you start to see the financial system differently. You understand why asset ownership matters. You understand why holding only cash in an inflationary environment is a risk most people don't recognize until it's too late. You understand why debt at scale creates structural incentives that shape policy for decades. War is not just tanks and treaties. It is bond issuance, monetary expansion, long-term interest obligations paid by people who never cast a vote on the conflict. And once you see that, you realize something sharper still. The people who design the financial system rarely design it to punish themselves. History doesn't repeat in identical form. But the arithmetic of debt and inflation doesn't change. Governments borrow. Central banks accommodate. Currency weakens. Assets adjust. Wages lag. Wealth concentrates. The invoice arrives quietly. The final lesson is simple and uncomfortable. War is almost never paid for by those who declare it. It is paid for by those who hold currency and depend on wages. In the years and decades that follow, the financial system spreads the burden forward and downward, while protecting those positioned upward and outward. If you want real financial literacy, you cannot ignore economic history. You cannot pretend deficits are someone else's problem. You cannot assume inflation is random. Wars are loud. The payment system behind them is silent. And in finance, it's always the silent mechanisms that shape your future.